Welcome to TheoTrade and the weekend update. It is November 5th, 2016. I am Don Kaufman. Let's get right to it. All right, here we are. The election week coming up. Volatility ultimately exploding in the markets. Where do we go from here? Well, during this update, we're going to be extremely forward looking. Granted, has the S&P been down 9 days in a row? Absolutely. Okay. But if you've made up a decision that this product, this S&P or the entire marketplace is oversold right now, I think you're doing yourself just a huge disservice. And I'm going to explain a little bit why. Number one, what we're going to look at here is the SPX to begin with. Now, you may not necessarily trade the SPX. Maybe you use something like the spiders. Hey, maybe you trade something like Apple or Facebook out there. That's neither here nor there. What's important, okay, in an event is that you quantify what some of that risk could look like entering into the event. And to do that, something we've been doing kind of week in and week out here, and we've been doing this now for almost a month, we're going to look at the November 7th expiration. All right, so this is what? This is an option that happens to expire on Monday. One of the first things that I want to point out to you, yes, it's a Monday expiration. It's before the election. But why do I point it out to you? One thing that stands out for a Monday, I don't know about you, but that looks like a whole lot of volatility, meaning that the weekend itself holds risks. The market is actually anticipating more risk appearing, for instance, on a Saturday or Sunday, but we're looking coming into just Monday, almost a $27 expected move. That is extraordinarily high. I'm like, well, compared to what? Well, let's actually go look at a comparison. So I'm going to jump on thinkorswim into what we term think back. Now, think back is just end of day data. I use this all the time, not necessarily for, here's a trade idea, but I use it all the time for explanation purposes. And it's to explain how extraordinary certain events can be from time to time. So here, I've actually jumped back in this particular case to just last Sunday. So what does that do? It leaves ultimately the October 31st expiration. And I want you to see what more normal has been lately. Well, lately a Monday expiration is held, well, in this case, a $17 expected move or a 10% implied volatility. Why? Nothing's going to go on over there. So go back another week over here. Again, you can go back to any given like Sunday afternoon and you look at these one-day options. Here's into October 10th. Oh, there's a $13 expected move. Oh, it's heart, wrenching out there. So what do you first notice? You notice the market's anticipating a lot more risk on Monday than we normally would. Okay, that's extremely notable. So we've had 9 down days in a row. And of course, every market technician is coming out of the woodwork right now. What are they doing? They're screaming, it's oversold. Markets were made to break technicians out there. That's what they do. All right. And there's no statistical precedence to say that just because there's 8 or 9 down days, that on the 10th day we have to be up. You can't look at this as a pure coin flip every single day. Okay? You got risk on the table. Do you want to go into this election long or do you want to go into this election short? And some of the selling that we've seen in recent trading sessions, it hasn't been phenomenal. I mean, what are we down here overall? About 2.5%. It's nothing, okay? It's a very mild move to the downside. And moreover, before I get deeper into the expected moves over here, I want to look at the S&Ps. Now, the lines drawn over here, it's neither here nor there, okay? But there is something that really stands out in the S&Ps that I do not think enough traders are quantifying and really giving credit to. And that's in sheer respect to the fact that we have been selling off. And again, I just forget about the chart for a second. The volume is by no means extraordinary. So what that ultimately entails is that we're selling off, okay? But it's more positioning. And what that means from like a trading firm standpoint, okay, it doesn't mean that folks are just unloading stocks left and right. Because if they were unloading stock left and right over the last 9 days, don't you think you would see it reflected in the volume? You're not getting any capitulation. You're not getting really a pickup in volume. I mean, the last couple of weeks in here and early, I'll zoom in for just a second here. But in early October, these are like low volatility, low movement days. And we were still doing almost 2 million S&P contracts. Now, why do I spend so much time looking at the S&P futures? Because people, they drive order flow for the whole marketplace. It doesn't matter per se what Apple or Google might do. Google's getting crushed lately. Apple's getting crushed lately. Newsflash, so is Amazon. You think it matters? No, because what they're doing is just bleeding off their positions. But, okay, there's one thing that's disconcerting, all right? The trading firms are out there, and yeah, there's definitely some sell-side activity. There's nothing intense, though, whatsoever. But I've noticed the trading firms, they're not just buying up volatility, all right? The volume over in the volatility products is extraordinary. Here in the S&Ps, not so much. So again, there's absolutely no sign, if you will, of the markets hitting a fever pitch to the downside. And again, the sell side activity has been mild. It's only been 2.5%. You have to realize that's not even like a statistically significant day. What that basically means is, hey, look back here, all right? That is a big trading day. That's the market going from 2170 all the way down, okay, to roughly 2112. Great. It's a 60 handle move, right? What have we had the last couple of trading sessions? And again, I'm just trying to zoom in and quantify this. What have we done? Well, we've gone from, let's call it 2135, and I'll even zoom back a little bit more. Here's 21, we'll even call it 2150 down to, 2080. But again, a multitude of trading days over there. So we haven't had any statistically significant move. And that's usually, what is statistically significant? Again, really, I call it over a 3% move in one trading session. We haven't seen that yet. So don't count out the idea like of a bounce. Of course, the markets can bounce over here. Are they oversold? Well, now this is going to be fun because, again, everywhere you go, all I'm hearing is so oversold. You can't possibly have 9 days. And of course, they compare it to the statistics of 2008. All right. Listen, I don't think this is easily compared to 2008. What I want you to recognize, though, is the probability of us going down, okay, is absolutely equivalent to the probability of us going up. It doesn't matter that we had 9 down days in a row at this point. And that's what you need to put kind of to the wayside. And sure, there's different technical studies, but I'll have fun with this. So if you look at one of the technical studies that we use here is the RSI Laguerre, and it's showing, again, in RSI land, it's, oversold, but things can stay oversold for a substantial amount. The fractal energy has come off. All right. And you're like, oh, that looks pretty exciting. So it's oversold. So I'll go out to a 1 year. Even on the 1 year, it's oversold. Let's go a little further over here. Let's go 3 years. Oh, look. Even on the 3 year, it's oversold. Okay. But the irony of this is this has been a unprecedented time. Right. So what do? I open up like a 10-month or 10-year monthly. Apologize. Got to get that right. It's a 10-year monthly. And you know what you find in a 10-year monthly? Oh, the S&P is overbought. It just hit overbought. Oh, it's all about time frame. And when you start to put things in a larger perspective over here, I mean, come on. We've been up since 2008. I don't want to hear just because we've had 9 down days, okay, that we're in, it's oversold territory. Yeah, in the shortest duration, we might be oversold. And we may have a wild bounce on Monday that everybody sells into. And you need to keep that in perspective. Now I'm going to get a little bit more serious before I go into those expected moves. One thing you need to keep in mind, we have a VVIX. For those of you that have absolutely no idea what the VVIX is, the volatility of the volatility index. Basically, what it's telling you over here is we're going in. What does that even mean? Okay, the VVIX only gets lit, and it is lit right now to 120. It only gets lit when there are traders buying options, and I'm going to be very, very specific in here, when traders are buying options in the VIX product itself. Now, forget about looking at the VIX. Oh, yes, the VIX is up. Okay, that's secondary. That's totally secondary for this conversation. What's going on right now is that out in the 30-day window, in these expiration cycles into the future, volatility is being bid drastically. And I cannot stress this enough. If you go and look at the VIX options themselves, you might find the VIX options themselves a little convoluted. But one thing that'll really help you understand them, look at the VIX options, but only look at like the 10-day options, okay, the standardized options, and look at the 73-day options. And what you're going to see in there is nothing short of some of the most magnificently large contract size that you have ever seen. If you look at the 10-day, all right, options inside of the VIX, and that's exactly what I've got open here, and open up all strikes and go to volume and open interest over here. In fact, hey, why not? I'll just go to volume and open interest. Look at the size that's trading. Now, that's not meant to intimidate you. That's meant for you just to respect the fact that it is a clear and decisive move from professional trade. All right, they are bidding volatility right now in a monstrosity way. So there's another important thing about the VVIX. After it breaks above 110, and again, we're looking at the VIX right now, but we're talking about the VVIX. After it breaks above 110, it doesn't really matter anymore. It just basically means put your helmet on, get under your desk, and start rocking back and forth because we're going in. It's at 120 right now, which again is wild levels. And I'll come into why, we believe it's this high. Now, the VVIX is really measuring like 10-day options and 73-day options out there, as well as these 45-day options. They're also seeing some liquidity, and all of them are obviously sky high. So somebody out there believes that there's not just substantial volatility, but because the VVIX is a 30-day average of volatility, it's important to denote the marketplace perceives risk. Okay, not just for the next week, but the marketplace perceives risk, okay, to the future. And that's one of the points I wanted to bring up at the VVIX hitting these crazy levels, and talk about some crazy levels. There happens to be a 3-day option over here, and it has 233% implied volatility. All right. The 10-day options, they're trading at 186% implied volatility. Now, much more importantly over here, again, does this mean the market's going to tank? No. But what it does mean is that, again, for all intents and purpose, all technical analysis, you throw it out the window when the VVIX is north of 110. And I know that that's bothersome to say, we're in a very oversold situation. It does not matter, okay? When you get a situation where we're north of 110, unpredictability reigns. That's it. Chaos rules the marketplace. Forget about it. And you go back to any period of time, and this is a fun little test over here. You go back to any period of time where the VVIX is north of 110, and you tell me, okay, what the market looked like at that time, okay? And you're going to see nothing less than pure and total randomness and chaos out there. Contract size in the markets, though, hasn't necessarily picked up. That's what we're going to be looking for Monday, Tuesday, Wednesday, Thursday of this week, is that we're going to start to get intensity back to the trade. Now, one of the most important things, that we're in a high risk situation, right? Newsflash. Now you're recognizing that the high risk situation, okay, it can be to either direction. And I'm going to give you my opinion based on this, okay? But there is nothing material that's going to tell you in the next couple of days. And people don't like to hear this, but there's nothing material that's going to show you, yes, we're going up, or yes, we're going down over here. And now we're going to go into the SPX, and I want to talk a little bit about the election itself. All politics aside, there's no place for politics, okay? We're done with that. When I say we're done with it, it doesn't matter, okay? It's inconsequential. Right now, you're in the hands of the volatility monster. And the volatility monster, okay, in my mind, that there's 3 possible scenarios in the outcome of this election, right? We have, one candidate win, we have the other candidate win, okay? Or we actually have indecision for a period of time. That's actually 3 possible outcomes over there, which ultimately means we may not know who wins the election, okay? Hopefully by Wednesday, but if not by Wednesday, okay? come Thursday, Friday of this week, we'll likely figure that out. There's, again, a lot of conversation about the possibility of not having a decision by Wednesday out there. And I think that that's a real outcome. And I think that the market's actually pricing that in, given the fact that many of the volatility levels are still lit up, okay, even into the, 11 days out into future expiration. So keep that in mind. Now, if we do not have an outcome come Wednesday, Thursday, Friday, okay, it will likely be markets to the downside and heavily to the downside. Again, markets, historically speaking, hate indecision. Okay, here's the part, though, I think that's much more important to interpret. What your outcome happens to be. I mean, again, if you look at the pundits out there, they're going to tell you Hillary wins, it's bullish. Trump wins, it's bearish. Okay? If that's true, then why are we up to a $60 expected move? And you gotta sometimes think about that. If that's true, like, why is there so much anticipation? Because if you looked at some of the betting sites over there, it's throwing, almost 70% for Hillary, 30% for Trump over there. To me, that's neither here nor there. All right. The markets are just anticipating a tremendous amount of risk, and that risk is going to be pretty much indiscriminate. And this is much more of an opinion now than it is going to be fact of the expected move. In my expectations, I think what we're going to see, okay, happens to be, regardless of the outcome of the election, markets initially will get bid to the upside. So I'm going to tell you again, these are my expectations for it. Markets initially get bid to the upside, which could provide a phenomenal opportunity. We're going to feel like we're going to explode higher. And then the street's going to come in and to sell into it, and they're going to sell into it heavily. Regardless of the candidate selection, regardless of the outcome, markets get bid and then whacked back. Why do I believe that? Well, very simply put, I'm not seeing intensity to the trade inside a lot of the products, but we are seeing firms that are very quietly, okay, letting go of positions, clearly 9 down days in a row. The issue that I happen to have right now is that billions and billions of dollars have been positioned into volatility products. And the volatility arbitrage firms and all the volatility players in the street, why are they trading volatility in such monumental amounts over here? And they are definitively buyers of volatility. It makes sense that regardless of the outcome, volatility could continue to explode, right? And they do extremely well in this circumstance. So there's so much activity in these volatility products. And you can look at things like option statistics over here, and you're going to see that the VIX day in and day out is traded almost 2 times the norm. Neither here nor there. But again, just the sheer magnitude in every volatility product that we've seen lately, okay, alone can cause markets to come down. That is the unwinding of all these volatility trades, and volatility took off, right? The unwinding of these volatility trades alone are enough to cause markets to come down hard and fast. And that is why, again, regardless of the outcome of the election, I believe that we are going to see some possibly prolonged sell-side activity. I mean, after all, as I showed you there to begin with, we looked at a 10-year monthly, and we're still in monstrously overbought territory. Now, okay, last but definitely not least, and we're going to continue this conversation a little bit on Monday with some different trade ideas for the marketplace. Last but not least, again, looking at the week, and what you're looking at here is November 9th, a $60 expected move into Friday. Here's November 11th, which is Friday. It's a $71 expected move, which is a fairly extreme number. Okay, again, given the circumstances, should that number be higher? I'm not entirely sure, but I want you to think about something, versus your position here, and bear with me. What a $71 expected move simply means. I'm going to close this up for a second. I'm going to try to draw it out for you. Okay, it means for the most part, okay, here is the SPX. And as I said, randomness, chaos rules when the VVIX is above 110. And that thing is at 120. Doesn't matter anymore. Forget about looking at the VVIX. Doesn't even matter if it goes higher at this point. It just means put your helmet on. We're going in. We're expecting this week, in a very normal occurrence, again, if you look at the expected move, that's plus $71, okay, or minus $71. But that is a normal occurrence. That's supposed to happen approximately 68% of the time. However, it's a probability of expiring, which means, hey, at the end of the week, we're supposed to be inside a $71 range higher or $71 range lower. But what this does not incorporate into it is what we call the probability of touching. And the probability of touching is roughly double, right, the probability of expiring. What that does is you take this expected move, which again, $71, double it. Oh, let's just round it. Now, you're $140 lower or $140 higher. And those, okay, are actual probable numbers that can be touched anytime in the next week. It's 6 days away, but it's going to be 5 trading days. In 5 trading days, $140 expectation of price movement from a probability of touching. How's that grab you? Because I wanted to put into context how serious I am about the VVIX being up, how serious it is that we're seeing a 31 vol. You don't take that stuff lightly, right? Sure, we've had some VIX in that level over there, and the VIX is at 22. Yeah, but the 5-day volatility is at 31, okay? So it means all hands on deck, we're going in. You price out. It's a 140-point swing. Now take that and compare it to your own portfolio. Now I'm sitting short almost 6,000 spider deltas. And for those of you unfamiliar with the spiders, come on, it's just the S&P. Easy enough, right? I'm short about 6,000 spider deltas, and the spiders are sitting on a $7 expected move. That means in a normal occurrence, you just take the $6,000, all right? For every dollar that the spiders moves, I'm going to make her lose $6,000. For every dollar they're going to move, I'm going to make her lose. But they're projecting a $7 movement either higher or lower. You do some quick math and it's plus or minus about $40,000. However, the probability of touching is a $14 move. So now you do some quick math over there like, whoa, Don, I'm looking at an $80,000 P&L swing this week. Do you know what your risk happens to be? If you don't, okay, we are going to be opening up the TheoTrade chat room and doing some really extended sessions on Tuesday and Wednesday. Now, for those of you that are members of TheoTrade, you're in the chat room anyway every single day. I urge you, Tuesday and Wednesday of this week, yes, during the election, all right? During the election, if we got to be there with you at 3 o'clock in the morning, we will be if the futures are moving. But coming into Tuesday the 8th, okay, and Wednesday the 9th. And Wednesday the 9th, I think, is where we're really going to see some wild movement in there. By all means, we are opening up the TheoTrade chat room to everybody. We're going to discuss risk mitigation tactics on Tuesday extensively. Tuesday, we're also going to give you good trade for the upside, good trade for the downside, right? In fact, you'll be able to trade both of those. So the election trade is coming. Stay tuned. Thanks, everybody, for joining us here at TheoTrade on the Weekend Update. Again, see everybody in the TheoTrade chat room all throughout the course of the week. Have a great weekend. Bye-bye.